I like it when I can make an investment in a company and in 3 or 4 years, I can get all my money back. If you're going to take all your money and put it into the market today, into the index, that's probably not the best idea. I think the single greatest skill an investor needs to do well is extreme patience.
Hello, Believe Nation. In today's video, I get to sit down with one of the world's greatest investors and pick his brain about investing, building wealth, and what made him so successful as an investor and what he's looking for in today's investments. Now, he's not only changed my life through his values, teachings, and principles, but he's impacted countless of lives within the investment community. He started the Pabrai Investment Funds in the early 2000s, right after the dot-com bubble, and since then has had a rate of return of 671 plus for his investors. He's not only an amazing investor, but he's also a philanthropist, starting the Dakshama Foundation in India, helping pull kids out of poverty and putting them through the IT program to change their lives and their families' lives. He's also written an amazing book that's highly regarded within the investment community called the Dhandho Investor that I would highly recommend you check out if you're looking to dive more into investing. So with that said, I hope you sit back, relax, and enjoy the interview. The first question I wanted to ask you would be, with the S&P 500 being at a PE of 40, and things kind of just out there in all-time highs, do you see any resemblance between the dot-com bubble and what's going on, and any caution that you feel right now in the markets?
Yeah, well, I think the dot-com bubble was more widespread. It was a little, each of these bubbles have their own nuances and characteristics. During the dot-com bubble, what happened is that a bunch of businesses that really had no revenues and not really much more than a website had gotten some crazy valuations and so on. And it was pretty widespread in the sense that people could create any kind of .com and it would get venture funding and kind of go from there. And some of that had spilled into the mainstream S&P stocks, like things like Coca-Cola was pretty highly priced, Microsoft, Cisco Systems, and so on. And later, all these stocks crashed and burned. So there was a bubble in the dot-coms. There was also a bubble in tech. And there was a bubble in what I would call maybe, well-recognized blue chips. If you look at the situation today, I think it's much narrower. In the sense that the real bubble is in the Robinhood names or the Wall Street bet names. So maybe you can add Bitcoin to that mix as well. So it's much narrower than what we had before. We do have some similarities in the sense that we have stretched valuations in a number of sexy tech businesses, Salesforce, Microsoft, Alphabet, Airbnb, all of those kinds of businesses. So there's some euphoria there, but it is nothing like what's happening with the Robinhood names and so on. And then when you get past this core, then I think it is questionable whether we have stretched valuations. Because we have very low interest rates, and if those low interest rates persist, that actually impacts long-term stock valuations. So I think there is definitely a bubble, but the bubble is much narrower.
And in terms of the popularity with the escaping the mutual funds and the high costs, and going over to the indexes, do you see a bubble within the indexes forming, or do you still think there is, more room for that to grow down the road?
Well, I mean, I think the S&P is clearly at elevated valuations. if an investor is young and going to dollar cost average over a long period of time, the S&P 500 is just fine. If you're going to take all your money and put it into the market today, into the index, that's probably not the best idea. So if you're a young investor, you've got decades of compounding ahead of you, then I don't think it matters.
Okay. In terms of with the low interest rates, and there's still being room for growth, do you see an adjustment in the PE ratios that we should be expecting from companies? I know in one of your earlier talks, and I know you've recently switched to going after spawners as opposed to the discounted pies. And I was curious to know, in terms of, thou shall not invest in a company over a PE of 10, should we be setting new barometers within, acceptable Ps that we'll just have to gulp down essentially?
Well, I would say that if you move from indexing to picking individual stocks, that is a significant step change. So if you're going to pick individual stocks, then you've got to have a very good idea of what kind of cash flows those individual businesses are likely to produce over the next 5 or 10 or 15 years. And if you have a good handle on that, then you can work backwards and discount those cash flows and come up with the intrinsic value for a business. Most humans would not be good at doing that. And most companies do not lend themselves to that type of forecasting that's relatively easy to do. So I would be reluctant to suggest that individual investors look at individual stocks because a price to earnings ratio is one data point. It's not the be all and end all of investing. It's a single data point. It has relevance, but it also may not have relevance in the case of many businesses.
And so in terms of distinguishing that the two people who are interested, the vast majority who maybe should take the indexes and dollar cost average, if they're not willing to take on the approach of diving into specific companies. The next step up for those individuals, and then I do really want to come back to the specific individuals who are curious to dive into specific companies as well. But I guess going back to the general mass, in terms of investing in an index versus something like Berkshire Hathaway, which is an index of itself, of course, and maybe taking that pursuit versus the index, do you see the Berkshire Hathaway having a long run even after Charlie and Warren part ways with it, essentially? I hope they're still around for 20 years plus, but
yeah, one could think of Berkshire kind of sort of like an index, though that's a little bit of a stretch. And I think that in today's environment, it would not be a bad idea if you were dollar cost averaging over a long time to do 50% S&P and 50% Berkshire. That's not a bad way to go. And I think both are valid. It's difficult for me to be clear which one would do better over the next 5 or 10 years. That's not clear to me.
Do you still think Berkshire does? It comes down to, I guess, the management of Berkshire and how much Charlie and Warren have built Berkshire. Do you still see the potential value within Berkshire even after those individuals have?
Yeah, I don't think it will matter. I mean, clearly Warren and Charlie are exceptional, but they have a deep bench and they have some really good managers, and they have done a lot of planning for succession. So I think that the bigger challenge for Berkshire is not so much the transition for Warren and Charlie. It's the problem of size. And they already face that problem today with Warren and Charlie in the mix. So size is a major factor which will serve as an anchor to their performance. But they've pulled rabbits out of hats, and they will continue to do that.
Okay, and in terms of the specific investor who is willing to dive into the companies, and going back to thou shalt not invest in PE of 10. Looking at a company, because the audience is very mixed between people who should take the index investing approach, dollar cost in Berkshire, but we do have a lot of Warren Buffett disciples and individuals. And so I guess in terms of when looking at companies, looking at, for example, spawners like Costco, for example, that you talked about, I believe it was 2 talks ago, and seeing that maybe there is a case to be made where they do have room to grow?
Yeah, I think Costco is a very good example. I think Costco is a incredible business. And I think it's a business that will be much larger in the future. For example, they just opened 1 store in China, which was mobbed. And they couldn't even let the people in because there was so much demand. Shelves got cleaned out. It is entirely possible that in 10 or 20 years, there are hundreds of stores of Costco in China. And it's also possible that at some point, the Chinese business of Costco may be bigger than the American business of Costco. And Costco is in very few countries. They're just in a handful of countries. So Costco could enter more countries. So I think there's many ways for Costco to grow quite significantly from where they are at today. But that does not mean that it would be a great long-term investment. So a business doing well in the future is usually a requirement for you to do well as an investor. But just because the business does it well does not mean you will do well. So Costco is not cheap by traditional metrics today. The future of Costco is well understood by the markets and many investors who are willing to pay up for it. It would not be clear to me whether it's better to invest in Costco or better to invest in Berkshire or better to invest in S&P 500. Between those 3, I couldn't tell you which one to do well. I would say this, that while I admire Costco tremendously, at current prices, I would not be a buyer of the stock.
In terms of making that distinguishing factor of not just with Costco just being the example of, Charlie, for example, saying, it's better to pay for a wonderful business at a fair price than, a decent business at an attractive price. With an example like Costco, where it's not cheap, like you just said, with the current business, how would you assess the risk for individuals who did want to take on that pursuit of not just Costco, but any business where you're investing in the potential something or multiple factors going right versus investing in the underlying business of what's already gone right?
Okay, so that's just to highlight why the individual stocks is fraught with peril. Let's just dive a little deeper into Costco, just so I can express what I'm trying to get to. So the market cap of Costco today is a little over 145 billion. Okay, and what Yahoo Finance is showing me is that the trailing PE ratio is 33.72. Let's just make the math simple. Let's say the market cap is, let's say it's 150 billion, and let's say the PE is 30, for example. Okay, so what that means is that Costco earned $5 billion in the last 12 months. And it will have some earnings stream coming out in the next 10 or 20 years. Okay. And let's say, for example, Costco's earnings. Let's just take and I haven't done this math before, I'm going to do it on the fly with you. But let's take a very bullish case on Costco. And let's say that Costco is able to double its earnings every 5 years. So 15% rate of earnings growth, which would be quite high. So what that would mean is that they would be making around 10 billion in 5 years, and they'd be making around 20 billion in 10 years. And so if you look at the next 10 years of cash flows, which start at 5 billion and end at 20 billion, all those cash flows together, we'd have to do the math on that, but basically, I'm just guesstimating it may be around maybe 100 billion or so, or less in total. Then you would discount those back, with some interest rate or something. You would take those back. You might discount it by 5% or something. I don't know. So the thing is that it's a business that you put out $150 today, and you get back less than $150 in the next 10 years after some very robust growth and assuming no hiccups. That does not strike me as the most exciting place to invest. Now, if we did the same math with GameStop or Tesla or Salesforce, for example, the math would look even more ridiculous. Costco is not in a bubble. It's not very overpriced. It's a very great business. But still, you can see that. And so I like it when I can make an investment in a company, and in 3 or 4 years, I can get all my money back. Right? If I could invest $150 in Costco, and in the next 4 years, the earnings were more than that, oh, that'd be a great investment. But that is not in the cards.
For the individuals out there who are looking to buy these wonderful businesses at a discount, but there just seems to be nothing out there for individuals in the United States, unless maybe you're looking globally. But for people who really do want to stay in their circle of competence and don't want to expand out of it, do you see a case to be made for people to who are willing to take on the knowledge of investing sit in cash, or do you think they should be potentially not missing the opportunity in the S&P 500 or Berkshire, for example?
These are difficult questions. I think the single greatest skill an investor needs to do well is extreme patience. And so if one wants to buy individual stocks and one is not able to find something, that's a pretty normal situation. It's probably safer to just let the cash sit, not put it into the index, because the index could go down. So then when the opportunities come up to buy stocks at great prices, your index could be down 20%. And so then you've now lost 20% of your firepower. So I think that if you are going to be a stock picker, willing to sit with sums in your checking account, not earning anything for long periods, is just par for the course.
And the market, eventually, you typically throughout history, we do see a correction or something where maybe there's an opportunity down the road.
I think I think if you're going to pick individual stocks, when I pick individual stocks, I really don't care about the market. And actually, the thing is, because there are 50,000 stocks around the world, individual companies are always going through issues at different times. So it doesn't even matter what's happening with the markets. There may be some event happening at some individual business which collapses the price for not very good reasons. And that's the opportunity you're looking for. You're looking for extreme mispricing. And in an auction-driven market, there's extreme mispricing happening all the time.
Mm-hmm. In terms of investing globally, I know I've heard you talk about being invited out from people to go look at their companies, and individuals helping you walk through the process. For the individual stockbroker who does want to take this journey and not just dollar cost through the index like Warren Buffett recommends, and just to escape the low fees. Is there a way that you recommend individuals who maybe don't have access to people who would be willing to help?
Yeah, I think the starting point should be businesses whose products and services you use. If you are a customer of Apple, you have some familiarity with the company to start with. So that's a good starting point. So if you just look at all the different products and services that you as an individual are consuming, it could be Amazon, it could be Spotify, number of different things. I would say those are the first businesses you should try to look at and try to get your arms around, because clearly they were able to convince you to become a customer. So they've been able to convince you to part with your precious dollars and become a customer. So I would say that sticking to circle of competence is important. The starting point could be just looking at. I mean, I've repeatedly found in looking back that there are many companies that I was a diehard fan of and a diehard customer of, and I failed to analyze the business properly, and they were huge home runs. And a lot of stuff could have been figured out if I had been willing to dive in. So I've lost a lot of, there's a lot of opportunity cost when I have not looked at these businesses more carefully. Because generally speaking, we are all very careful about who we interact with and which companies we do business with. And so if they've passed that first layer of having trust with you, that means the business is doing something right. And it probably means that they may have some legs in the future. So I think that's the starting point.
In terms of over the years, in terms of your circle of competence, has that naturally just grown through digging in the companies and being exposed to the other ones? Or have you actively took it upon yourself through methods or certain things to help expand your circle of competence?
Yeah, I mean, I think that one should not fixate on increasing or broadening the circle of competence. I think if you're curious about business, it is a natural outcome. I think if you're curious about different companies and you read up on them and drill down and figure them out, that circle will gradually expand. But you don't need to really sweat it. It's going to be happening by osmosis.
In terms of, I guess, taking another route. So I know circle of competence, Warren Buffett talks a lot about, knowing what you don't know, which would be the circle of competence. And the other aspect being, of course, the margin of safety, and the other aspect being management, which I'm curious to ask you about. So let's say you do have a business in your circle of competence and you were able to find it at an attractive price. And maybe perhaps the story changes with management, a CEO stepping down, or how would you assess that risk, even getting it at a good price? What framework would you go through? Would you cut the portfolio down a bit based on that story?
I think every situation is going to be different. There are some businesses where management is very critical. And there are other businesses where management to a large extent. I mean, if you owned stock in the Coca-Cola company and the CEO dropped dead tomorrow, that shouldn't be a reason to sell the stock. a lot of CEOs have come and gone from Coke. It's really the brand and the moat that is relevant there. And they probably have plenty of people who could lead the business and such. So I think it depends on the business. Management is critical for most companies. So it just depends. I think I can't make a blanket statement about that. Because each situation will be different.
Mm-hmm. In terms of a company like Seritage Growth Properties, where you see a CFO and a CEO leave, do you having to redig maybe back through the process of investing and just looking at that company again? Do you go through the underlying business again when something like that happens and just make sure everything is okay? Or
I will duck the question on Seritage because I really don't want to talk about businesses that are currently in the portfolio. But I think what is publicly known is that our stake did not change after the CFO and the CEO left. So both of them left in 2020, and I think we posted our position holdings as of the end of the year. And if you look at our holdings on our 13F filings on December 31st and September 30th, there's nothing meaningfully different. So I can just give you that fact, but I can't go into any more color on that. At some point in the future, we will not own Seritage. I don't know when that is, but if we talk after that, then we will tear it apart.
Perfect. I look forward to that.
Okay.
In terms of going back to you talking about Coke, for example, and just finding a wonderful business where even if the CEO drops dead, maybe it's not necessarily a case to sell because it's such a wonderful business. Looking for these spawners, the new discovery that you talked about in the lecture you recently gave, how have coming to this discovery with the spawners made you update any big changes within the checklist you look for when investing in companies?
Well, I think the checklist is more to avoid permanent losses of capital. So the checklist is a more kind of defensive tool to help you avoid pitfalls. It's not designed to identify, great home runs. But generally speaking, if a company has spawner DNA, it's a business worth paying attention to because it's got multiple ways to nirvana. And so I think that I would just say that if you look at a company, just to give you an example, SoftBank in Japan, it's not a spawner, but SoftBank has had many investments that have turned out to be useless. They made many errors in investing, but their record looks exceptionally good because they had a few investments where they were completely right and they were smart enough to hold it all the way through. So, for example, I think Masa invested like $25 or $27 million into Alibaba, and they still own, I think, a 20% stake in Alibaba. And it's a massive home run. It's a large portion of the total value of SoftBank is the stake in Alibaba. Same with Yahoo Japan. They made an investment in Yahoo Japan. Very little was invested. It's worth a lot. Alibaba is clearly a spawner. It's a great spawner. And Masa, for whatever reason, decided to buy and hold Alibaba. And that one decision overrides dozens of stupid ones. And so that's the nature of investing, is that you don't need to always get it right. But I think if you generally invest in spawners below or at reasonable valuations, and you hang on for the ride, some very good things can happen to you.
Mm. In terms of finding, when you were looking at all these spawners, were there any common themes that you found earlier on to catch them sooner? Was there return on invested capital higher? Was there any common attributes that you found when looking back at all these spawners that we've had recently that you are now applying to look for the new ones to come that could be a 10 to 100 bagger?
Yeah. So when I kind of got somewhat enlightened about spawners, the first thing I did is I looked in my portfolio, and I noticed that there were some businesses I already owned a portion of, which had spawner DNA. So I felt like Forrest Gump at that point. I invested in a fruit company out west. So that was great. But what it did help me with, what it did was the framework of me looking at that business changed, or those businesses changed. Where I said, okay, now that we understand how spawning works, we need to let this ride for a while. Let it ride. Don't sweat it that, the PE is 20 now and something else is available, a PE of 8 or something. Let it ride. So that was the first thing. And the second is that when I'm looking at new businesses or businesses that I'm studying businesses all the time, it's easy for me to tell what is and isn't a spawner. And so I can start segmenting them. And if I run into spawners and they look reasonably priced and so on, and spawning is a very wide area. There's a continuum of spawning. There are some companies which could have some spawning ability, but they're not kind of major spawners. On the other hand, there's something like Amazon, which is an apex spawner, which is just extremely good at it, and they focus on it. So as you get closer to the spectrum towards the Alibabas and the Amazons of the world, those are the businesses that you have to be willing to pay up for, and you have to be willing to hold for a long time.
And for the I believe it was Charlie who said, I'm paraphrasing here, even if it's a mistake, it corrects itself long term.
Yeah, I mean, I think a good time is the friend of a good business. And I mean, like if you bought Costco at current prices and the market crashed 30% tomorrow, Costco may drop more than 30%. But if you just kept it for 5 or 10 years, the odds that you would lose money are close to zero.
Yeah, very fascinated with the spawner discovery, and you sharing this information with me and everyone. I guess in terms of when looking for these spawners, so of course, Alibaba or Amazon, not go it. How much bigger could they grow? So you won't be finding a 10 to 100 bagger there, maybe.
Jeff still says it's day one.
Right.
It's still day one. Mm-hmm. Don't tell Jeff Amazon's not going to grow.
Right.
Because that's not what he believes.
Mm-hmm.
Yeah. I mean, I think Amazon is not an easy business to invest in today. It may still continue to do extremely well for investors for a long time. The same with Alibaba. But clearly, I mean, the thing is that the smaller and earlier that you're able to find the business, which has spawning DNA, the issue is that you have greater runway if that happens, but you also have greater uncertainty because they haven't gone through the journey. They may or may not get there without stumbling, right? So that's what makes it somewhat challenging. But if you had a number of bets, maybe 5 or 10 bets like that, You really need just one or two to work. And then you ride off into the sunset like Masa.
Right, right. I guess in terms of for the individual stock picker, when viewing that and looking at companies, maybe small cap, mid cap companies who aren't the blue chips, maybe companies that are not in the news as much, harder to follow. I know over leveraging is a huge aspect that you're not a fan of with companies. Are there any other areas of indication should people be wary of for the individual stock picker when looking for companies that have this greater runway besides overload of debt?
Yeah, no, I think that there are many businesses because like I said, there are 50,000 stocks globally. There's many businesses that still have massive runways ahead of them and have had 10 or 20 years of history that you can look at. So if a business has 20 years of history, and that history should be able to tell you something about the ability of that business to navigate and survive and grow in the next decade or two, those things would mitigate risk factors. And so it's not true that every business with a lot of history is already as big as Amazon or Alibaba and the story's over. That's not true. There are many businesses where at the age of 20, they're just getting started.
I guess looking for a track record of the past.
Sometimes it could be a manager who moves into a business and the manager has a long record. So it just depends, it's I think these are the things that make my life interesting when I look at different businesses, because each one is different. Each one has nuances going on with it. And the challenge I have is to first make sure that I'm operating within my circle of competence, and then, find the ones with the great spawner DNA and the great runway ahead without paying too much for them.
Taking it in another direction, speaking of your life, I'm very curious to know what the day in the life of Mohnish looks like.
Well, I mean, I think a day in my life is, it just depends actually what's going on what day. I mean, I have very few things on my calendar. I try to avoid putting things on my calendar. I learned that from Buffett. Buffett runs almost an empty calendar. So the first thing I try to do is I really try to control, what goes on the calendar. And so I'm an introvert by nature. That works well for me. I'm happy when I'm with myself and my books and my reading. That's good. And so the way I plan my week is really to keep it completely open. That's the way I try to, and keep it open so that serendipity is possible. So I can read different things that I may have an interest in. I can look at different things. Recently I got 2 books, and I haven't read either one too much yet. But they're both books on General Electric. Okay, so one is a book called Lights Out, which is I think it's a critical look at Jeff Immelt and GE and how poorly the business has done in the last 20 years while Jeff was running it. And the second is a book by Jeff Immelt that just came out, which is called Hot Seat. And in that book, there are very few things that went wrong at GE from Jeff's point of view. When you read the other book, which is Lights Out, it's a basket case, right? And so to me, it's interesting to read both the books to see the different points of view. I mean, I'm never going to invest in GE. Okay, that's not in the cards. I'm not interested. But I am curious about how this company that was trading at 50 times earnings in the Jack Welch era before Jeff Immelt came in, and how it, has lost its way and now it's trying to get its way back. It's just interesting. This is the nature of business, right?
Mm-hmm.
And so I think that in terms of my my schedule and such, I like to keep things open so that if I do find something, some juicy meat with some good meat on the bone, then I can dive in, and see if it is truly a wonderful piece of meat or not.
Right. And I guess going back to your reading, reading taking up, the interesting thing about every successful investor is they love to read, and so I'm curious to know how much do you read per week? Is that where most of your time is taking up?
Yeah, I mean, the job description is reading and thinking. So I think the reading is diverse. I still read newspapers in physical form. So I have 3 newspapers I read every day. So the Wall Street Journal, New York Times, and Financial Times, all the physical copies of all 3. The weekends I get Barron's as well, which is a good read. So that's the newspaper reading is happening all the time. Then in addition to that, there are maybe 100 books a year or something that I'm reading, and then beyond that, there's annual reports, and then drill downs on companies and things along those lines.
In terms of everything you've read, I guess every book you've read, are there 3 books you would say are a must read for people who do want to pursue investing as a career?
Yeah, I mean, I think that I would put Poor Charlie's Almanac up there as one of the best books to read. I think that one book, if you read it carefully, is better than a college degree and much cheaper. And I try to reread that every year. And every year when I reread it, I find stuff that I could swear I never read before. I think then some of the Buffett biographies, like the one I like is Lowenstein's Making of American Capitalists, is a very good read. And I think a third book, if I can plug that, is a book that's coming out in about 6 weeks, and it's by a guy named William Green, and it's called Richer, Wiser, Happier. And he profiles a bunch of great investors in there, and I'm the opening batsman. So maybe that's why I'm biased. But William is a very gifted writer, and I think people will get a lot out of his book. I learned a lot from his book.
And that comes out 6 weeks from now.
Yeah, and you can go on Amazon and pre-order it just to make sure they don't run out.
Right. And the Dhandho Investor as well, your own book.
The Dhandho Investor, of course, sure, is perfectly fine. No, but I think William's book is really spectacular. It helped me redo my frameworks when he finally sent me the manuscript and such to look at. And so I think he's done an exceptional job. He's a very gifted writer. And I think the book will do really well.
Excited to check that out.
Yeah.
Well, I guess before I move on to another question, would you ever write a book on spawners down the road as this thesis plays out in this new discovery?
I think that at this point, there are no plans. And also, I think the spawner framework is very new. I had some thoughts on it, which I shared with the students and then on YouTube. I think maybe in the next few years, I might get more maturity around the framework. But I'm not focused on writing any more books. It's too much work.
Right. Yes. But thank you for doing so. The Dhandho Investor, like I told you at the beginning, just really launched me into entrepreneurship and investing. One of the first 3 books I ever read. But
yeah, and I think my motivation for writing that book was to crystallize certain frameworks in my own mind. So I really wrote that book for myself, and just to get certain things crystallized. So even if I were to do something with the spawners, it would really be, I would doing it from the point of view. And one of the reasons I shared that framework is because I actually was hoping I would get feedback from people who saw the video or people in the class, which would help me with the framework. And that has been happening. I've gotten a bunch of different emails from different people and such. And so that's wonderful.
Well, if you do, I'll be your first reader, creating that second book. But I've also been curious about, as you continue to read and dive into these companies you love that maybe aren't at attractive prices that you could buy them at, and you build this wish list. As you build this wish list, how do you manage that wish list when it's in a time of high valuations and it just seems to keep growing? How do you stay on track of that wish list and not get it overflowing necessarily?
Yeah, I mean, I think the wish list is fine, but I think a better approach is to keep hunting. So because we have so many stocks around the world, there are events taking place that are affecting individual businesses. Okay, like for example, when the Chinese government gets bent out of shape on what Jack Ma said, Alibaba's stock fell. It didn't matter what was happening to the index or the markets, it fell, right? And if you had a viewpoint on whether the issues are temporary or permanent and such, it may be something that's actionable. So like that, there is constantly, because all these businesses are living, breathing entities, they're going through ups and downs. They are releasing different data to the market. Sometimes the markets don't like what they hear. And so you have all of that playing out. There will for sure be businesses and countries and entities that get widely mispriced in the middle of all that. So I think if you can keep a list of businesses you love and waiting to go on sale, that's fine. But I would say keep the hunt on, looking for new ones, and just keep sifting through that. And I enjoy that hunt.
Right. And
it's a lot of fun, yeah.
And in terms of that, going on the hunt and going for looking through the 50,000 stocks out there, and for the individual stock picker who is from the United States, Canada, where you that's in your circle of competence.
You still have 5,000 stocks.
Right.
So no problem. There's still plenty.
Right.
Yeah.
In terms of building the confidence of an investor, when you do find something that's undervalued, how do you distinguish the two between knowing that you found it versus, maybe Wall Street or no one else finding it? How do you have that confidence when making that decision? Is it just the amount of work you put in, or is it the experience you've had over the years?
Yeah, I mean, I think in different situations, it's different. If you get to a point of an epiphany, and that epiphany, you have a very strong amount of conviction about that epiphany, you can act on that. Okay, so for example, in 2012, I had made an investment in Fiat Chrysler automobiles, right? And I hated the auto business. I always hated the auto business. It's a terrible business. And but when I was studying fiat, I spent about 3 months studying it. It was really fascinating for me. I encountered that they had brought in a spectacular manager. And this manager, Sergio Marchioni, who's passed away now, was thoroughly off the charts. I mean, there were Harvard case studies on him. There was a lot of trademarks in the past that you could look at about what he had done. And the second is that when GM and Fiat went through bankruptcy, they really cleaned out a lot of the cobwebs and ugliness of the business. So, for example, the UAW contracts got redone. And they got redone in a manner that made Detroit a great place to build cars. And so there was a number of things happening at the same time. And I could see that the market just hated those businesses. Because they'd come out of bankruptcy and they were not focusing on the fact that there was a great manager who had come in and that Fiat was a company that had 135 billion in sales and the whole market cap was 5 billion. And Ferrari was inside Fiat, inside that 5 billion. Ferrari alone is worth 30 plus billion now. So it was a very significant home run because you had 2 or 3 things going on at the same time, which were all going to compound on each other. So Detroit went from being one of the worst places to build a car to being one of the best. It became very competitive. You had a great manager, and Fiat Chrysler had a very strong footprint on SUVs and trucks. And SUVs and trucks were becoming, they've in fact now become more than half the market. They've taken over sedans, right? So they were just perfectly positioned. So there were these multiple layers of things that were all going to move, all those factors were going to move in the same direction. And so if you get conviction like that, people didn't want to invest in some Italian company and they didn't want to invest in some auto company and all of these things. And it had a lot of debt. It was mispriced. And that's it. In investing, you have plenty of time to do the work. There's no hurry. And you can spend the time, do the work, and then if 7 moons line up, you can make an investment. And if things you don't feel great about them, or you feel goosey about something, take a pass, move on to the next one.
Right. And when you did feel the diving into fiat, for example, did you? I guess how long did this logic reasoning add up through the research to come out with the decision of fiat would be a great opportunity?
Yeah, I mean, I spent several months studying it, but I started buying the stock after a few weeks. But I was just so fascinated with the business, and there was so much to study. There were so many books written on the auto business. And I read the UAW contracts, and there was a lot of history on Sergio I could look at. So there was a ton of data available, and it all pointed to me like this would be a difficult business to lose money on. This investment would be very unlikely to not work out.
Right.
I mean, basically. Fiat got gifted Chrysler. They paid almost nothing for it because the US government was almost ready to liquidate Chrysler. So they picked up a very significant asset for next to nothing. And that asset is incredibly valuable. Mm-hmm. I mean, just the truck business in the US, for example, has 25% import tariffs. So you could not make a truck in China and bring it to the US and be competitive because you'd pay a 25% tariff on that. The labor component in a truck is less than 3 or 4% of the price. So if Chinese labor is zero, you would make the truck maybe for 5% less. Okay, and then you'd have a 25% tariff to bring it in.
Mm-hmm.
So you couldn't, and the loyalty levels of the truck buyers, they're very loyal to the three brands. So this is why Toyota, which has been in the truck business in the US forever, even manufacturing in Texas, has not gotten traction. I mean, the powerful, being behemoth that is Toyota, even they couldn't crack it.
Interesting.
So you just peel the layers, and then you could see the same thing with the Jeep business. I mean, you look at a product like the Wrangler. The Wrangler forever has been a monopoly. The margins they have on the Wranglers are insane because there's been no competition. Now the Ford has introduced a Bronco, and there's some companies trying to go. But when I talk to Wrangler owners, they will not buy any other car. To them, no other car exists. Mm-hmm. Okay, so that means you've got a very serious moat around that business.
Right. Yes. Thank you for sharing that. Yeah, that was. Yeah.
Yeah.
I guess as my final question that I'm curious to ask you about before we wrap this up, I know you said in terms of one of the greatest lessons you pulled was digging into Warren Buffett's shareholder letters and finding the mistakes. Are there any other areas that people who do want to become great investors should look into and study and research besides just Warren Buffett's shareholder letters that you would recommend?
Well, I think there's many individuals that are worth studying. I think that if there's a friend of mine in the UK, Nick Sleep, and he retired in 2014, but his letters are on the internet, Nomad Investment Partnership. And so they are wonderful to read. So I think there's a number of great investors, and some have written books, and there are other resources, or they've given talks and so on. So I think if one is interested in the area, there's plenty to read and think about.
Right. Well, thank you so much. It was a pleasure and honor to ask you these questions and talk to you and get your feedback on just an array of things. I know it was a lot to cover, but thank you so much.
Jeremy, it was a pleasure. Thank you very much.
Thank you.
If you want another amazing video highlighting excellence in the Indian community, check it out right there next to me. I think you'll enjoy it. Continue to believe, and I'll see you there.